start recording the session. And shall I start or shall I wait for? I think we should
Uh,
start on time.
Yeah, we
yes,
should.
yes.
People will join. So
Yeah.
Okay. I
Dipanjan, will you be
think. Hello.
Dipanjan, will you be sharing the slides?
Yes, yes, yes. The first
Okay.
part I have already shared, and the second part also I will share after the
Okay.
session.
Very good.
Okay. So, are you able to see my screen?
Yes.
Yes. Yes.
Okay. So, I'll take just 5 minutes for the recap of the earlier session so that we are in tune. Okay. So, last session we have just started, and many people fear the stock market. They think that stock market is something very fearsome. Some people they think it is a gambling, losing the money, but unfortunately it is not like that. And then we have presented the survey, and the survey result also, I don't know, we should prepare also. I took some snapshot. Yes. So this is the survey result. So most of the people they feel that it is possible to make money, and uh, they have bought the Indian stocks. Then what is your preferred investment strategy? We have seen that most of the people are investing in the mutual funds. Many people in the real estate, the direct stocks. Very few people are actually investing, almost zero. And then knowledge about the software market, though people are investing in the mutual fund, mostly they do not have the investment knowledge, at least in the stock market. And then they have picked up the stock market because their own expert, their field newspaper, they have advised. They are associated with the stock market mostly. uh, People are less than 6 months, and then they feel that current COVID lockdown scenario, they feel they are very much optimistic, and that's why attending this session. Okay. So now let me go back to these things. That the objective of the session, we want to make investor know and take their own decision, and how to build up their strategies, how not to make mistakes, because that's why I tell that software, the stock market lessons learned. There are various kinds of the investment: fixed deposit, mutual fund, shares, and the real estate. We have discussed the pros and cons, and I have told you in the long run, shares of the stock markets are the most rewarding things if you stay calm in the stock market. We have talked about the inflation, and then also discussed that mostly in India, because your interest earned on the fixed deposits and the taxation, so you have to beat the inflation, and their investment in the fixed deposits is not really rewarding. We have dealt with some data, and we have seen that over a period of time, the stock market is falling down and then again rebounding. This COVID-19 will be a no exception situation, but over a period of time, we have seen that the stock market is increasing and increasing. Obviously, you can see that the latest fall is one of the biggest fall, maybe in the last 50 years, but still it will come out. We have also seen a relative performance of the stock market, and we have seen, I have made a special video how to judge this. I've shared the video also, and we have seen even during these lockdown conditions, some of the stocks are rising very fast. In fact, many people are also taking the opportunities. There are stocks of the long-term scenario, and we have seen over a period of time, even there are stocks which are more than 200% return. So this COVID fall down is nothing for those stocks. So we have concluded if you want to make short-term money, it is possible. If you want to make long-term money, it is possible. And then the qualities needed for the success is knowledge, passion, and karma, the decision making. You have to spend time, you have to be alert, intelligence is not very much required, and emotion has to be avoided. Now, let us go for the second session of the class 2 of the stock market. Okay, so we have discussed this earlier, but let us re-emphasize on the scenario that the knowledge is the key factor of the stock market. Benjamin Franklin has made a statement: an investment in knowledge pays the best interest. And the difference between us, the ordinary investor, and the mutual fund manager is that they know much more than us, but they know. It is not difficult as a subject, but a continuous learning effort can make you enabled to learn a lot of money. Peter Lynch, he is one of the biggest investor and mutual fund manager in USA. So he has made a comment that spend at least as much time researching a stock as you choosing a refrigerator. But we do not do generally. Even for the mutual fund, we just go and buy something. We do not know what is inside that. Spending time on the stock market is the biggest success factor, not the luck or intelligence. So it is the question of the time. Okay. We also need to know the knowledge of the mistakes. Mr. Warren Buffett, he is continuously, sometimes the entire day he spends behind understanding a company. He goes to the details of the company and then only invests. The knowledge. Now we can see that, okay, I know that you need to know a lot about the stock market. Whether it is something like whether we need to become a surgeon, we first need to become MBBS engineer and perhaps MD in surgery. No, it is not like that. And even we know that if you are not qualified enough, you cannot do the surgery. But the stock market is not like that. The stock market is for everybody. It is from various professions. It is from engineering background for the finance. For the finance people, it may be a little bit easier, but not that it is a mandatory subject. You can be from any profession and gain expertise in the stock market. Here, what you need to do, you need to learn a little bit, and then you need to plan a little bit, and then you need to act. That means you need to take decision either buy or hold or sell. And then you turn back, because stock market is such a field that it will either reward you or punish you. There cannot be a third scenario. So you will come to know whatever decision you have taken in the past, whether it is the right decision or the wrong decision. And that makes stock market very, very interesting subject. So many people are actually, they are not aware that what is the mistake. They always say the market is bad. I am not bad, so typically it is my bad luck. No, it is not the bad luck. It is actually a wrong decision taken by you. And then when you check back and then you learn, and then again out of the learning you do again one planning. So it goes in a continuous cycle. We will discuss about this more. The time. The time is the biggest factor. I mean, spending time on the stock market is the biggest success factor, not the luck, not the intelligence. And typically, if you do not have time, I mean, we all are busy, we know. We are professional. We even work in our office hours, I mean, more than even 8, 9 hours, 10 hours, sometimes 12 hours even. We know that it is difficult to get out, to get the time. But typically, my estimate is that initially, in the beginning, maybe in the weekend, you spend some time, 1 or 2 hours, behind learning about the stock market. But then, once you start learning it, then you need to spend more time on monitoring. And that should be at least 30 minutes for the stocks that you are holding currently. I mean, you have decided to buy, and twice in a week, maybe middle of the week after the office hours, and then at the end of the week, maybe you spend another 30 minutes. But if you do not spend in a disciplined way any time, then better not to be in the stock market. I mean, you can rely on the mutual fund. I mean, it is like that. The mutual fund manager will also drive you, but earlier I have discussed and I have explained you that they are paid heavily, and the amount of money that you are giving to them for the maintenance, it is quite huge. And if you stay more than 10 years with the mutual fund, the majority of the fee that you are paying to the mutual fund manager are actually not getting invested. So I have typically given a statement that if 3% is the load of the mutual fund manager over a period of time of 10 years, you are going to pay 30%. That means 100 rupee, whatever you are investing, 30 rupee is going behind the mutual fund manager. There is another disadvantage of the mutual fund manager I have also explained, and you will understand more. A mutual fund contains a set of the stocks. It may be some 20 stocks, 25 stocks, even 30 stocks, even more. There are proportions. So whenever the market is falling down, then even if the mutual fund managers do not want, they are forced to sell the stocks. Whereas you can hold and you can decide that what stocks to sell, what stocks not to sell. So these decisions mutual fund managers are not able to do because you as an investor sometimes exit from the mutual fund. Okay, now this is the most difficult thing which many of the people, they do not know. There are videos in the YouTube by Devashish Majumdar, which greatly explains the difficulties in the mutual fund. Anyway, so I would like to go some philosophical notes, because right now I am dealing a little bit, what do you call, from the top, because when we will go into a little bit deeper into the stock market, if we do not clear the fundamental ideas, then it will be difficult for you to understand. So Benjamin Graham is one of the famous author in multiple books in the stock market, including Intelligent Investor. In fact, his book is considered like a Bible by our the very famous investor, Mr. Warren Buffett. So he told, I mean, he has in fact forwarded the book of Benjamin Graham in his lifetime, and we know that many of the key principles what Benjamin Graham has advised is still valid today across all countries. So one of the key note is that buy cheap and sell dear. Like some time back, Mr. Hopner was telling that our healthiness stock has fallen down. And why it has fallen down, we will see more of the investor psychology. But the thing is that it has fallen down because there are many sellers and not much buyers. And so there are opportunists who will buy this stock because healthiness as a company is not a bad company. So his first philosophy is that buy cheap and sell dear. The second is that the market is a pendulum that swings between the unsustainable optimism. and unjustified pessimism. What does it mean? You see that the stock market, there is nothing called the right price. Like if you go to a shop and then try to buy any item, you will see that there are some cost associated with that. How does the cost comes? Okay, the cost will come. There is a manufacturing cost of that particular product. Now, added to that, there will be profit for the companies. Okay, and how to deal with the profit we have discussed earlier, because the company makes a profit. Part of the profit it distributes to the shareholders in terms of the dividends, and rest it keeps as a reserve. Okay. Now after that, I mean, they decide the product price. It goes into the market. In the market, it goes from one hand to another hand. There are dealers, there are agents, sellers who keep their own percentage, and finally it reaches to the end customer. So there is some price and there are competitors. However, for the stock market, there is no real price. I mean, you will see that a stock is traded in the market for a value, and if you ask why is this price, you will not get answer. Okay. The most important thing is that financial success is inside yourself. It is not that your luck is bad. It is not like the market is bad. So if there is something wrong inside me regarding the decision, then I'll be punished. If I take the right decision at any condition in the market, then it is only me, the decision maker. Even at any point of time, whether the market is down or up, it is possible to make money. Okay, and one has to know that how to make money. It is an intelligent investor need not be having high IQ or the SAT score. I have mentioned also earlier. It simply means being patient, disciplined, eager to learn. You also must be able to harness your emotions and think for yourself. This is the most important statement. In stock market, if you have formed the strategy, now the strategy is different for different people. I will explain about the strategy a little bit later on. But if you have followed a strategy, then you have followed it in a disciplined way, it is possible to make money. Later on, I will share you a video from one person called Adam Koo. If you search in the YouTube, you will come to know. He has excellent video. So here you need not know nothing about a company, but he has set a target that in a month, if you follow a particular strategy, it is possible to make 3% of the profit. That means if you invest 100 rupee, it is possible to make 3 rupee. And you have to repeat this, because every time your prediction will not be true. Even suppose you are going to trade, the trade term means here meaning the short term doing. That means you are buying a stock and you are selling a stock after say 10 days or 12 days. And suppose you take 3-4 stocks and you repeat this exercise, buy, sell, with a gap of 10 to 12 days. And if your prediction is just 50% correct, you will also make money with the strategy. And he has told that you will make much more than 3%, which means 3 into 12, 48% profit per year is practically possible. In fact, I have tested it. You can also test it. You don't have to invest money for the testing. What you have to make, you have to take a strategy and you can do a shadow trading. Shadow trading is something I will explain later on, but it is not actually paying from your pocket. It is just checking that whether your strategy is true or not. Let us go further. Key advices. There are defensive investors in the stock market, and there are aggressive or the very active investor in the stock market. the difference between two is that defensive investor is little bit, I would say, very much, they avoid serious money. They are not, they don't want to take a risk, okay? But they also want to be a little bit free from the effort. I've seen mentality of the people that they want to invest something, including the post office or the debt fund and etc. And then they want to free from the effort. They want to free from any anxieties or the worries. The investment they do not want to link, or they do not want to get affected, because if something is falling down, that it hurts because your hard-earned money is falling down. And then if it is going up, it is fine. But I cannot tolerate that the stock market is falling down. I cannot tolerate that whatever I have earned today, that value is down from the 100 rupees to the 80 rupees. I cannot tolerate. So there are people, and that's how the whole market is driven, between the defensive investor and an aggressive or the active investor. The difference between two, the aggressive investor, he is little bit willing to spend more time, and then he is literally in the market because he is continuously not also in the buy mode. He is the buy and sell mode. He takes both decisions. Okay. For example, if you are a driver of a car, when you take charge of the wheel, because many people, they do not like to drive, they want somebody will drive for them. Okay, if you are of that nature, then obviously stock market is not the cup of tea. You will give it to a mutual fund manager or any fund manager whom you are trusting. But actually, this game is trusting yourself. So when somebody is taking a car wheel, then sometimes he has to accelerate and sometimes he has to put a brake, depending on the condition. Now he has to know that when to put a brake and when to accelerate. So we have seen that over a period of time, the enterprising or the aggressive investor is making much more money than the passive investor. So he has given 3 clues. Number 1, you must thoroughly analyze the company and the soundness of the underlying business before you buy the stock. Number 1. Without analyzing a company, never ever buy a stock. Number 2, you must deliberately protect yourself against serious losses. Even if you are buying a good company, that does not make your success path. That means even the good company's stock market can fall down for various reasons. And then number 3 is that you must aspire to adequate, not extraordinary performance. Now, this is the third is very important, because many people, they play with the emotion. They have the greed. Now, today I am making money, maybe another 1 year, 2 years, 3 years, the stock is going up, and I'm spending more amount of the money to buy the stock more and more. But then it has started falling down. Now, when it has started falling down, I still have the hope that no, the price will come up. But here, what do you call it? Feeling of the greed comes into the mind. So in the stock market, you cannot have greed, you cannot have fear. These are the two most important things. So we need to understand a little bit about the bull and the bear market. What is that? You know, stock markets, they are always falling down or going up. The curve is never equal. You cannot expect that the curve is the same or continuously going up. There are few companies where the prices are continuously going up, but in general, the prices go up, then prices fall down. For example, now during the COVID 19 scenario, the stock market, all over the market has crashed. So it is the bear market. Typically, the bear market is that the price falls 20% from that peak. It has many of the stocks we have seen, it has fallen down, what I would call around maybe 40 to even 50%. And then when it goes up, this is the bull. So there is always fight between the bear and the bull. And those who are winning, that is driving the stock market. So whenever the stock prices are going up, then you should buy the stock. Whenever the stock markets are going down, you should exit, partially exit, or protect the capital and go out of the stock market. Now that you have to understand. It is something like that. If you are going to a seashore and then want to bathe in the sea, you cannot fight with the waves. So you have to understand the waves, and whenever the wave is up, then you have to jump or you have to put your head down, because you cannot control the sea wave. All you have to know that how is the nature of the wave and adjust with the wave. So stock market is exactly like that. Now we need to here know little bit of candlesticks. I will not go details about the candlesticks, but I will go a basic fundamental, because you can see that the prices which are continuously up and down, and the prices are going up and down because there are buyers and the sellers in the market. So they are continuously what you call negotiating what is the price of a stock market. And typically this is a day chart. I mean, even it can be a 15 minutes chart. I mean, the time duration does not matter. So even it can be a week. So let us assume that this is the day chart. The stock market in the India, in both Bombay Stock Exchange and the National Stock Exchange, starts from 9:30 and it ends at exactly 3:30 without any break. So assume that the stock is starting at this particular price, and then it goes down, then it goes up, then goes down, go up like that. It reaches a peak and then it falls down. So then overall, if you see that the stock has started from a price and has ended at another price which is higher than the opening price. So in the stock market, daily you will get the four values: the open price, close price, the lowest price, and the highest price. Now this forms something like, it is called candle. And the candle will look like this. If the stock market, the opening price is lower than the closing price, then it is indicated with a white or sometimes in a green, and it is a bullish day. Wherever when the stock price falls down, it will start the price and then it will close with a price which is less, and then it is a bearish candle. And the bearish candle is typically the black one. It is also showed as a red one. And then bearish is also high. It has got the highest value in the particular day or in the lowest value. So if you understand the game of the bull and the bear, you will be in the stock market. You have to understand that the logic, and later on we will see there is a pattern of the bearish and the bullish. Now typically I have taken a chart of, this is a day candle. That means every day you will see there are certain signal. So one day, for example, 1st of April, there will be the opening price, which is the 2000 rupees, and the 2000 rupees will be here, and the closing price 1877. Because the closing price is less than 2000, that's why it has become black. In another case of the bullish one, you will see, oh, by the way, I have not explained, let me go back to the another. It is, there is a shadow, the upper shadow and the lower shadow. And you will see another thing, that there is a reversal of the signal. I mean, the opening price for the bullish is at the below, whereas the opening price for a bearish candle is at the top. Now, sometimes people confuse it, why the principle is there, but it is defined like that. So you have to understand the difference. The opening, like the close, also is at the higher position. Here, close is at the lower position, exactly opposite. Now, here, now if we go, you will see that there are certain candlesticks which does not have any shadow at the bottom. It can be like that. For example, the price has started here 2295 and then the price has closed 2406, and in the peak suddenly it has shot some 247. That's all you have to understand. Now there are patterns in the candlesticks which we will discuss in details in the technical analysis. Now people can play on this pattern only and then they can make money. I will show you. So before that, let us go for understanding of the market capitalization, which means large cap, mid cap, and the small cap. Many people, they are aware of this term because when they buy the mutual fund, then they typically try to see whether it's a large cap stock or maybe large cap mutual fund or the mid cap mutual fund or even the small cap mutual fund. Market capitalization. The market capitalization by definition is the number of shares outstanding multiplied by the closing price per share. So the market capitalization of a stock, of a company stock, is changing day by day. Okay. How do you know that market number of shares outstanding? As I've explained in the earlier session, that whenever the company is floating a share, because the company needs money from the public, there are many ways to collect money. You can go to the bank, you can get the loan, or you can go to the public and then float share. Basically the publics are investing money and it starts with the IPO or the initial public offer, and you are giving out certain number of the shares. So this number of the shares will come here in this number of the shares outstanding and then multiplied by closing price. High market capitalization, it indicates, that means more number of the interested investors, more secure share. What is the more secure share? Because you will see there are some shares, there are a large number of shares. I will I will show later on that in the Bombay Stock Exchange, more than 5,000 number of companies have registered. There are many shares which are hardly traded in the market. That means there is no buyer, there is no seller. But you do not want, correct? A share, something is like a commodity. You are having something asset, and there is no buyer. So suppose you have bought the share, after few years, you will see that nobody is trying to buy the share. So your share, whatever you have invested, is basically worthless. It is a junk. So people, they obviously, being an investor, you do not like that. Okay, it may be traded in the market for some period of time. You will see that okay, there are candlesticks. It is going up, going down. It is happening. But slowly, it is actually losing interest of the investors. So high capital market capitalization means more secure share, reputation for producing more quality and goods and services. They are quite renowned companies. They are having a history of consistent dividend payment. I have explained earlier. What is the dividend? This is a company earns money and then it has got a profit. The part of the profit it shares with the investors, typically the shareholders, and that is the dividend. So even, you have the share, you will be continuously earning dividend, typically quarterly, and it has got a good record of the dividend payment, and it is a steadily growing company. So this is a high market cap. Typically, the SEBI has come out with a large cap, mid cap, small cap. There are a lot of confusions about the definitions because the market capitalization is never fixed. So more or less, the companies whose market cap value is more than 20,000 crore, is the large cap. But SEBI has defined that if you typically sort out the companies from the highest market cap to the lowest market cap, the first 100 company in terms of the the highest market capitalization will be considered as a large cap company. Similarly, there are mid cap companies, and then there are, from the second, 101st to the 250th company is a mid cap, and below that it is a small cap company. Now, what is the difference between all these things? Basically, the difference is that the large cap company, the risk involved is a little bit lower, whereas the mid cap is a high, and the small cap risk is very high. The liquidity, large cap, you can sell immediately in the market. I have discussed earlier the liquidity of the real estate. Real estate sometimes becomes very, very illiquid. You are having an asset, you are not able to sell it. It happens typically in the many apartments in Bangalore. You are having the value, you are thinking that you are having a big amount, but you are not able to sell it. It can happen with the land. It can happen also with the shares. If you are having small cap, you will not be able to sell in the market. The return expectation. Now, as we know that the risk is low in the large cap, but you cannot also expect a very, very high amount in the large cap. Whereas in the mid cap is pretty high. And the small cap, you can really ride the roller coaster. The company information, if you want to know about the company, the visibility, the insight of the company, the large cap, lot of information is available. Mid cap, also available. But the small cap, you can hardly know about the company. Okay. So, because there are very less people which are interested about the small cap company. So, the investors or the people who are actually buying the stocks, they do not do much research on the small cap companies. The fund holding. The funds holding means there are many institutional investors about which we will talk later on. Their investment is quite large in the large cap. Okay. So how do we find and that which are the large cap, which are the small cap? So let us go. Okay. So we can go here, Bombay Stock Exchange. We can also go the NSE or the National Stock Exchange. You will see that here there are different indices, and then here large cap, here small cap, and here mid cap. If you click here, you will see these are the companies, Tata Motors, UPL, all these things. This is the large cap. Okay. And then individually inside the large cap, these are the companies. For example, you can see the Reliance, it is highly traded in the market. If I click here, you will see the market capitalization. I have earlier commented that more than 20,000 crore. You can see that 9,30,000 crore is the market capitalization. Okay. Now, if you see that Reliance also, the return is not so bad. For example, if you go here, the 1 year it has shown data. But if you go the higher, the 1 year, the Reliance price is not so high. But I will go here out of that, and then maybe I will invest. There is another chart, minute.in. So if you see that the Reliance over a period of time from January 2010 till January 2016 was almost flat, but then it is rising. So it is not that if you have invested in the large cap companies, you will make money. Now here you will see that the investors who have invested in the 6-year period of time that Reliance stock has not given you any return. So if it has not got any return, there is no point of staying invested in the Reliance. So I will also talk about that how you deal with the stock market. Stock market is something like that. The relationship between the stock and you is not like the parent and children relationship. It should be the relationship between an employer and the employee. Typically, if the employee, that means the stocks under you, is giving you a good return, take care of that. But if it does not giving good return, then they have to be out of your portfolio. You have to throw away. So you have to be like a CEO of a company who is a little bit ruthless about the stock market. Okay. So the biggest question in the stock market, why does the stock price move up or move down? If you know that rule, that why a stock price moves up and moves down, you are actually ruling the stock market. But there are many, many factors. There are certain fundamental factors, and I will explain all these things. But typically, I mean, consider one vegetable market. Okay, there is a seller sitting here. There is a buyer sitting here. The seller is asking for a price. The buyer is quoting for a price. That okay. Obviously, the buyer will say something is vegetable. If you go, the 20 rupees a kg. The buyer will start, no, I will give you 16 rupees a kg, not 20 rupees a kg. And then there will be negotiation. Now, if you see there are more number of sellers in the market and very few buyers are there, obviously the price will drop because this is a law of economics. Now, this is the fundamental reason of a stock market. But there are key parameters. One of the biggest parameter is the fundamental factor. Fundamental factor is the overall health of the economy. How the company is making the earnings or the turnover, how it is making the profit, how the company is growing over a period of time, both in terms of the turnover as well as the profit. What is the credit rating of the company? Because many company takes loan and then they have to pay back the interest, okay, to the companies where from they have taken the loan. Okay, how is the credit rating? For example, I mean, there are many companies who have taken loan from the banks. They are not able to pay back the loan, and those companies will fall down. Typically, we know the case of Vijay Mallya. He was not able to pay back the loan. Okay, and that's why there are many banks or the financial institutions, they go into NPA or the non-performing asset because the companies who have taken loan, they are not able to pay back. And associated with that, there is a credit rating. That means how good you are in paying back the loan. They are the companies, you will be seeing there are many companies who are very high on the debt. That means they have taken lot amount from the market, from the different companies. And there are companies who are almost debt-free. Those are the good companies. There are technical factors. We have not learned about the subject of the technical factor, but the technical analysis will decide when to buy and when to sell. And there is a historical past performance of the data about that. I will just deviate from that and I will go here. You will see some of the stocks. You will see this is the typically candlesticks, but you will see for a long time this stock was up. Now, if a stock is up, then that means there are more buyer pressure than the seller pressure. So the stock is going up. Now it is something like that is a motion. When the stock price is going up, more people are buying. When the stock price is going down, then more people are selling. And there is a trend. The trend is that is overall it is going up. So the trade also makes a sentiment among the investor. If some stock price is going on, then also they are very, very hopeful about the stock. Currently, the stock price has fallen down. While it has fallen down, it is nothing bad with the company because the complete economy is down, and this particular company has given lot of loan in the market. For example, if somebody, the Ola or Uber driver, they have taken all the loans from these companies, and then the investors know that Ola Uber driver will not be able to pay back the interest because their earning is almost zero nowadays. Okay, like that, there are many institutions who have taken loan. They will be now defaulting loan because they do not have any earning. With that thing, the company's earning will obviously fall down. So with that prediction, the Bajaj Finance stock has fallen down. But from the beginning, if you see a large, long-term data, the company is nothing bad. Okay. So what I'm trying to tell you, the technical analysis also makes what we call a sentiment. Then the third factor is the market sentiment. The market sentiment is something like, oh, there is some news or something overall sentiment of the investor. It is not like the real story inside the company. Okay. I can mention about market sentiment like a few years back in 2015. There was a company, Nestle. It's a very famous FMCG company, fast moving capital goods. There was a very bad news about the company that it was giving lot of Ajinomoto, which is a cancer producing, and because of that, the Maggi, which is a very, very popular product, okay, that was banned. In fact, it was banned in Gujarat and multiple places, and the stock prices of Nestle fell down heavily. Now, if you see from the overall period of time, it has crashed heavily. It is purely based on the market sentiment. After few years, then Government of India has taken out that what you call stay order on Nestle, and then again market sentiment became bad. Became good. So if you see typically the Nestle falling down, so it has happened in year 2005 or so. Okay, and then Nestle did not move much, and then you will see from that price it has been zooming, and now even with the COVID action, the stock market is not falling down. It has fallen down for some period of time, and those, including me, I have invested in Nestle. I've invested, when the price was around 14,400 or something, and now it has zoomed to 18,000. So this is typically the sentiment. There is nothing bad about the company. Okay. Then there is a decision of the FPI, FII, and DII. Who are they? Now, we are investing in the stock market. That means we are buying or selling the shares. But we are not the big players. Who are the big players? The mutual fund managers. Typically, the domestic institutional investors. They are the big players. You are giving money to the mutual fund managers or domestic players. Even we are doing the fixed deposit to the banks, and the bank is now investing into the stock market. Okay. People are giving to the insurance companies money. Say they are giving to LIC, and where LIC is keeping the money? Because they are doing business, correct? So if they are getting 100 rupees from you, they have to generate money on that. How do they generate money? They also invest in the stock market. So they are from the domestic institutional investor. Like that, there are foreign institutional investors and foreign portfolio investors. Foreign portfolio investors are typically the people who will invest, they will buy the Indian stocks, they will buy the Indian mutual fund, So they will invest in that. And then foreign institutional investors are similar to the FPI people, but they are large in number. Typically, the investors will be across the world. They will be buying the Indian stocks. Why they will be interested in buying the Indian stock? They might be interested because sometime back Indian GDP was more than 7% and it was the fastest and the highest GDP in the world. So people were thinking that, I mean, the investors in the foreign market, they were thinking that if I now invest money in India, it will be growing very fast. So they will not be uh, investing in USA even if they may be the resident of the USA, because in USA the inflation is quite low and the return on the money in USA is also low. So there will be always foreign institutional investors. Now, if you simply note that whether FIIs are pumping more money, there is a data also published. If you go to the money control, you can see on the day-to-day basis how much they are investing, how much they are putting down. They are the big investors. So if they are uh, taking out large amount of the money, typically they are selling large amount of the stocks, you will see suddenly Indian market will crash. It is going to happen because there are more sellers in the market. Okay. So we are almost done. I will just touch up on the basic principles and then I will take the questions. The basic principles will be explained in the next class. So what are the basic principles? The first, we have to know that how much money you have to invest in the shares. People, they do not know. Okay. They have got, I mean, people, they earn some money, then they spend some money. The balance, which is called the reserve, that means something your savings, they keep in the bank. They sometimes they invest in real estate, but they do not know how much money. So it is a very big question, how much portion of the money you can afford to keep in the stock market. And then we'll also talk about the stock picking strategies, what particular shares to buy. We have to also know when to buy and when to sell. This is the biggest art. We have to know the risk management. You know, always we have to do risk management. It is like you have to drive a car. You want to go to your office by driving a car. You know that you have to be on the road. When you are on the road, there are chances of accident. In the stock market also, there are chances of accident. But you have to take certain measures. So you also can drive safely if you follow certain rules. So risk management means understanding certain safety measures. If you apply, you will be always winner in the stock market. The difference between the losers in the stock market and the winners in the stock market is that the winners know how to do risk management. The losers, they do not know how to do risk management. Then another important is that you have to monitor the performance regularly. In the stock market, it is not like that. I have given some money, I have never examined how they are performing, including the people who are investing in the mutual fund. They must monitor what is the performance of the mutual fund managers on their invested amount. Then another factor is the control of emotions. We have explained something, but we will explain much more detail. The knowledge and the continuous learning and usage of certain checklists and as many as tools possible. That will make you successful. The more and more automation you bring into this field, the more successful you will become. One of the automation I have shown you earlier, one of the Excel file, I have also recorded a video. Now I want to stop here. This is 1 hour is over, and then maybe I can take some questions. That's all. And I would also request if someone can take a screenshot and then who have attended this session. I mean, maybe someone can help. So I will come to know. Otherwise, in Teams, there is no record that who has attended the session. Yes, any questions? Hello?
Devanshan, hi, Pradeep here.
Yeah.
I just want to know what are the formulas or guidelines do you prefer to first screen the list of stocks? Because as you know that there are large number of listed stocks in the market, and to start off we need to screen some of them.
Exactly.
So
Exactly.
will you be taking us through in coming
Yes.
sessions? Okay,
Yes.
yeah.
The next class will go much more detail, because one of the slide I have shown you regarding Peter Lynch, the famous book, that before buying a refrigerator, you have to do a lot of research, correct? When you go for buying a television, refrigerator, what do? You see what are the common products available in the market and you do research. So before buying a share, so you have to know, because there are a large number of shares available in the market. Okay. So in the next class, I will go and then exactly guide you that how to pick up the shares. And this is quite dynamic decision. That means tomorrow you are deciding based on certain parameter. The parameters will be almost the same. So at the end also I developed a checklist, and I have seen that the checklist, if I apply this checklist on a stock and it passes through that checklist, that means the stock is good. I can really buy that stock. Okay. So in the next class, I will explain you in detail what is the stock picking strategies. That means what shares to buy. Okay.
Yeah.
For example, you might have bought the Siemens Healthineers share. Can I ask you that why did you buy the stock? What is the reason?
Siemens share?
Yeah, because you work for this company?
One of the reason.
Okay.
Of the reason, and I had bought Healthineers because I see that there is a future. That is why I had invested in.
Okay. So these things I will explain in the next class. Yes, it is not like that you are working for a company. When you are a stock market investor, obviously the company that you are working, you will have the maximum trust and you will have maximum amount of the knowledge, obviously. Okay. And also you believe that the Siemens is a long-term sustainer. That means it has stayed in the world. It has been doing business for a long time. So that gives you certain confidence, correct? So we'll talk about different stock picking strategies. We'll go systematically one by one. Okay. Otherwise also, without knowing how good a company, you can make market. You can make money in the stock market. It is possible, but it is quite risky. I will not advise, because the current focus of the discussion is that you will be as an investor. You will not be as a trader. Trader is an outlook where people will be buying for short-term profit making. It is also possible. I will show also that the techniques that the trader will typically do and how they make money. Okay, many people, including Rakesh Jhunjhunwala, they have earned a lot of money by initial days by doing the trading. Okay, but it is a little bit risky. The investment is such a game that you will not get the heart attack in 1 or 2 days. You will peacefully work and you will start investing. Okay, so I will share this strategy next class.
Yeah.
Any other question?
Yeah,
Sir, this is Sandil here. So like last week after our session, right, I was just looking at the different stocks. So
Okay.
one of the example that I saw is like, for example, I was just reading, they said it is always good to invest in utility stock. So I was just
Okay.
looking at Tata Power. So the historical data is that around 1 year back, I think it was around double or more than double the price. And now it has come down to less than half and it's slowly beginning to pick up. So do you think that stock will pick up?
No. You know why? Okay.
No.
One of the very misconception that people will have that a stock was earlier costly and now it is very cheap. In fact, long back when I started investing in the stock market, I also had the same feeling. Okay, there was something called Renuka sugar. Okay, so it was one time very high, and then it fell down. So when it fell down, I had the feeling, oh my God, the stock is now available. Now, the stock, it was one time it was 100 rupee, 101 rupee per share. Now it is 31 rupees. So typically a feeling will be given to the investors, oh my God, the stock is now so much cheap. But you are not asking a question, why this stock is cheap? Why this value is 31,000, whereas if I go to the Nestle share, how much it is? It is now 17,000. So first fundamental question should come into your mind. Why a stock value is 17,000? Another stock is a Tata Motor is only 31 rupees. Why? The fundamental reason is that there are hardly any buyer for the Tata Power. And there are large amount of the buyer for the Nestle. This is number one. Then you should also think that it is not only assessing the Tata Power, but assessing all the power companies. If you have opened the newspaper, you will see the power companies, whether Tata Power, Adani Power, NTPC, the private, public, everything. The power companies are running through a serious trouble. They are competing now with the solar companies. And the solar companies, the power available is far, far cheaper than the coal-based power companies. So the companies that have invested, typically Tata and etc. For example, Adani Power, they have bought a large number of the coal field in Australia. Okay, now Australian government has become very smart. They are now charging Adani. So now their power prices have gone up, but the solar companies are offering much cheaper rates. So they are not able to sustain. Okay, so now Tata Power, I would not say, I will explain you more about how is the industry as a whole going. Okay, then you will come to know whether the Tata Power is a good place to invest. But
Okay.
currently do not understand.
Okay, sir.
And as an investor, you would not like to see. Today it is 30 rupees. Tomorrow it can go down 10 rupees also. Because there is a
Okay.
trend. You can see surely the trend of the Tata Power is going down and down. It's never coming up. Okay.
Okay.
Any other question?
Debanjan, this is Manju here. Again, you
Hi.
said that this Nestle is going up like 17,000 and so, but some shares they will do the splitting also, right? So the cost might be lower. This
You
thing
are
also.
exactly. I have not explained you about the cost. I have only explained
Okay.
you the relative performance.
Okay.
Okay. That means the Nestle is going up and up. Okay. Nestle is going up and up. And another company is going down. So you have to do the comparison. And the fundamental thing is that the Nestle shares are of demand. That's why it is going up. There are
Okay.
more amount of the buyer in the market than the sellers in the market. Okay.
Okay. Debanjan, I have one more question. Is it good to invest in SMEs?
SMEs means, these
Yeah,
are
this small
terms.
scale. Yeah, that in Bombay Stock Exchange, you'll get this small scales. I mean, it's not listed in NSE. It's like
No,
a new
don't
company.
invest.
Yeah. Okay.
I showed you another slide. You remember, no? This one.
Okay.
So even the small cap companies, their risk factor is very, very high.
Okay.
Okay. You can do a very small portion of the money you can invest in the SMEs, but again, you have to study that company in and out. Unfortunately, not much company information is available.
Mhm.
Okay. So
And also,
this
is it good to invest on IPOs? I mean, when they listed initially?
no.
Okay.
I will explain the reason later on. But basically, IPO prices are very much unscientific in nature. In fact, if you have remembered the Tata Power itself, initially, I think Anil Ambani has floated the share. It came out with the 400 rupees per share. And what is the current price? Is the 30 rupees.
Mhm.
See, because it does not have any historical record of a sustained way of profit making. So IPOs are most risky to invest. Okay? But if you know certain good companies who have been performing, their data is available, they are in the market for more than 5 or 6 years, and they are really good companies in the same. Warren Buffett has floated a term something like economic mode. What is that economic mode? I mean, it stands out of the other companies in the same domain. For example, if it is a pharmaceuticals company, how good or whether it is an exclusive firm with respect to the other pharmaceuticals companies. Then, if it is an economic moat, then it can make a lot of money. Then it has got a future, though it does not have a past data. But generally, if you want a safe investment, you have to always go by the past data. If past performance is good, that does not, I mean, guarantee you that your future performance will be also good. But generally, there is a trend.
Banshin, one question. I mean, you said you wouldn't invest in an IPO. If I look at our company, Siemens Healthineers,
Yes.
when there was the IPO, it was at 28 and it shot up to 45. So in the meantime, it's 41. So in this specific case, it would have been a very good investment.
No, it is not true because Siemens Healthineers was earlier part of the Siemens.
Okay.
And the Siemens is a long-term sustained company. But
Okay.
suppose there is a company which is newly entering in the public stock market.
Okay,
whose
so you're
background
referring
is-
only to companies who didn't exist before as a stock listed organization.
Exactly.
Okay.
Or even if it was listed, I mean, it existed for, but it was their performance was not much visible to the public. But Siemens Healthineers was part of that, and we also, and many people they know whenever the Siemens came out with the data in the what you call AGM, they had to also publish in each sector what are the performance. So Siemens Healthineers part of the data was already in the public domain. So investors knew about that.
Yeah.
And also investors knew that healthcare is such a what do you call such a domain. It is part of the essential services. Okay, so it is one of the basic need. So the company will grow. So Siemens Healthineers, that's why it is not truly a company without a historical background.
Okay.
Any
But
other
again,
question?
yeah, Devanjan, just to take this as a reference, but again, see, SBI has a good this thing, right? I mean, I brought SBI cards recently. It listed at 750 IPO. Now it is like some 530 plus or something. I mean, so it, yeah, again, SBI has a lot of this thing, right? I mean,
Correct.
it is not
I
always.
told you, no.
Yeah.
Because, okay, now you bought the stock of the credit card business. No, do you
Yeah,
really understand the credit card business?
I think
Have
that
you
has the
really
largest credit card in India. I think second largest or something like that. SBI.
But now, why it is falling down? Question is
Maybe
that.
COVID and this lockdown and business is going down. Maybe because that is the reason.
Exactly. Okay, maybe it will again come out. Okay, but currently, all the credit card companies. So it is not only that you have to know about a company. You have to know the complete economics behind it. Okay, so the company and the economics, they are related. Okay, so when you are in the stock market, you have to also understand the economics.
Okay. Yeah.
And
Thanks,
if you
Devan.
know, for every stock which is falling down, there is a reason behind that. Every stock which is going up, there is a reason behind that. As an investor, your job is to find out the reason. And if you can find the right reason, you are a successful investor. That's all.
Yeah. Thanks, Devan. Yeah.
Okay, and thank you very much. And if someone can take whoever is attended, I'll be very pleased and send it. And if you are interested, then I will continue with the session next Friday, sharp at 6:30. Okay. I'll
Okay.
also post the video and the presentation up to this one. Okay. And if any question is there, you can ask in the Yammer also. Happy to.
Yeah. Thanks a lot, Dipanshin. Happy and have a nice weekend. Stay safe, stay healthy. Bye bye.
Thank you. Bye bye.
Thank you, Devanjan. Bye.
Bye
Thanks,
bye.
Devan. Bye.
Thanks, Devan. Thank you, Devan.
Thank you.
Thank you. Bye.
Bye, Devanjan. Thanks.